This is highly implausible for most industrial and financial circumstances. In an industry subject to restriction on competition, the margin or spread between the competitive required rate of return and the actual rates of return on capital pursued by existing firms in the industry is incentive for potential new entrants to contest the market. For example, suppose an industry with a monopoly supplier who earns above competitive profits on capital and production and is owned by traded equities, which, let us assume for simplicity, are acclaimed to total net profit. In other words, let's ignore internal management who actually skim off the surplus profits, which is obviously very common, particularly in finance. In order to equalise the net yield from equity ownership in this monopoly with yields on other equities or returns on other forms of income yield and wealth, the total money value of the equities which constitute ownership of the monopoly firm will tend to exceed the replacement cost of the real capital employed in production. The greater this divergence between the financial value of the firm and its replacement cost, the greater must be the threat of new entrants, a fact which could hardly escape the monopoly firm. So my point here is that a monopolised firm or a firm with some advantage due to absence of competition, if it's owned by equities, there is still free entry and exit, more or less, to the equities, which are a share of ownership of these firms. Hence, the returns on capital in non-competitive industries are best conceived of as the sum of a competitive required rate of return plus margins. The latter determined by a complex of economically relevant factors pertaining to particular industries or commodities, which determine the contestability of particular markets. The competitive returns therefore remain an anchor to non-competitive target rates of return in some degree or other. The resulting system of commodity price determination will not be different in its formal structure from a price system with differential profit rates due to differences in risk and illiquidity. It is well known that such differential profit rates can easily be incorporated into scrapper price systems. There is finally the third question of whether markups have integrity as independent explanatory variables in price theory. From the standpoint of Scrapper's system, in which the circular character of the production system makes transparent the mutual dependence or simultaneous determination of prices and costs, there naturally arises a suspicion about this also. If costs are not independent of prices, then in a markup pricing framework, one would expect costs not to be independent of markups either. This suspicion concerning markups has been tested, of course, by Steedman 1992. The partial, and here are the results of that investigation summarised. The partial equilibrium form of markup pricing cannot be sustained. In general, each industry or commodity price depends upon markups in all industries producing basic commodities in the sense of Scrapper page 8. When subject to a constraint of minimum levels of real wages or intersectoral technological constraints, there is interdependence between the spectrum of values different markups can take. For vertically integrated industries, markups are not meaningful, independent causative variables, and allowing for joint production, further difficulties arise. Nevertheless, in principle, markups can be preserved as independent variables with respect to commodity prices and costs, but this still leaves open the question of their dependence upon competitive rates of return. Even in the absence of such dependence, non-competitive pricing is better conceived of in terms of above competitive target rates of return on capital rather than markups on cost of production. The notion of non-competitive pricing conceptualises a departure from competitive pricing and therefore can only be clearly understood from the perspective of a robust theory of the latter. I then turn to some comments on income distribution surplus. The markup approach to price theory is at the same time also offered as a theory of income distribution. To the extent that markups could serve to determine wage-price ratios, the theory of markups is also a theory of real wages. Steedman's 1992 at least partly compromises this element of the post-Keynesian project as well. Furthermore, to the extent that markups are reducible to target rates of return, the resulting theory of distribution is rendered effectively equivalent to Scratter's system with differential profit rates. Two other unorthodox approaches to distribution that are worth noting are the Cambridge growth equation causation from the rate of accumulation to the general rate of profit, and finally the possibility of directly determining real wages by reference to the balance of bargaining power around the labour contract. The former, the Cambridge growth equation, has been subjected to substantial and I think convincing conceptual and theoretical criticism. Outside the theoretical confines of steady state growth, the rate of accumulation is not a variable independent of prices and hence is not capable of being an explanatory variable with respect to the rate of profit. More substantively, the saving investment equality, which is the point of departure for all formulations of the Cambridge growth equation, allows the causation from actual accumulation to only the realised or ex post rate of profit, not the normal rate of profit. Now that I see Professor Bolognani sitting so close to the front, I should say that my written text is full of acknowledgements to all the people from whom I have taken these ideas, and I am not bothering.
I wanted to hear that. Raise your voice.
I thought I would say, and I will not bother in the oral given out of time to make all these acknowledgements. The latter profit concept, the normal profit rate, is the one that would be necessary in order to enable accumulation to be a determining variable for the kind of long period theory of distribution and normal prices envisioned in Stratter's system. And on the wage, direct determination of the real wage by bargaining is now endorsed, I think, by virtually nobody, since whatever its relevance in 1776 or 1821 or 1867, it is accepted that the labour contract now determines only money wages in a fiat money system, with real wages determined by commodity pricing in relation to money wages. This does not necessarily mean that the labour contract is irrelevant to real wage determination, since money wage behaviour could influence the course of wage price ratios temporarily or even permanently, and here I have acknowledged there are. All three of these possibilities may be read as proposals for closing Stratter's system. It seems to me that the most plausible proposed approach to closure for the situation of developed economies in recent decades is the notion of profit rates in production being regulated by interest rates, independently determined in the money markets, with monetary policy playing a decisive role. But at a more fundamental level, it may be questioned whether economic theory should seek a general, a priori, and at the same time determinate theory of functional distribution in the capitalist economy. I make this suggestion advisedly because, of course, at any point in time, there are definite particular outcomes for wages, profit rates, and so on. Something is determining them, even if they just happen to be at that time. What I have in mind here is that the deepest significance of the degree of freedom is as an expression in the Stratter system, is as an expression of the truth that a decentralised competitive economic system in and of itself does not foreclose the functional distribution of income. Rates of return to labour, capital and so on are open to determination by wider social forces. This analytical implication is just an expression, I think, of the fact that Stratter's approach is indeed a surplus approach. Above some minimum levels, real wages are not necessary payments or costs for ensuring the viability and reproduction of the economic system, and likewise, above some minima, neither are rates of return on capital necessary remunerations or costs of production and reproduction. The distribution of the social surplus remains open and contestable even under conditions of thoroughgoing competition. In marginalist theory, this kind of surplus, conceptually, is not to be found. All remunerations are conceived of as functionally necessary, at least at the margin, to induce the equilibrium quantities of factors of production.